Welcome to Iggy Video Reviews, a new segment on our YouTube channel. I'm Iggy the Investing Iguana, and I'm excited to share with you my insights on Singapore Real Estate Investment Trusts, or S-REITs. In this video, I'll be discussing some significant updates that could make S-REITs an even more attractive investment opportunity. We'll dive into the proposed rule changes, the impact of interest rates, and identify which sectors are poised for growth. By the end of this video, you'll have a better understanding of whether now is the right time to consider adding S-REITs to your investment portfolio. Before we dive in, I want to give credit to the CNA Insider team for their informative video, which provided valuable insights that helped shape our discussion today. Their content provided a solid foundation for us to explore the latest developments in the S-REIT space. Now, let's get started and explore the exciting updates in the world of S-REITs. Now, let's dive deeper into the proposed rule changes that are generating buzz in the S-REIT space. The Monetary Authority of Singapore, MAS, is considering granting S-REITs more flexibility in managing their balance sheets, which could be a game changer. The new leverage limit would allow REITs to have a maximum gearing of 50% with an interest cover ratio, ICR, of 1.5 times. In simpler terms, this means REITs could potentially take on more debt to fund expansion, which could lead to exciting growth opportunities. However, it's worth noting that most S-REIT managers have already demonstrated prudence in their financial management. The average gearing ratio in the industry is around 38–39%, which indicates that these managers prioritize maintaining a resilient balance sheet. This cautious approach is a reassuring sign for investors who value stability and are looking for steady returns. It will be interesting to see how S-REIT managers respond to these proposed rule changes and whether they will take advantage of the increased flexibility to drive growth while maintaining their commitment to financial discipline. However, there are some REITs that could benefit more from these changes, such as EC World REIT, 58%, Manulife US REIT, 57%, and Prime US REIT, 48%. These REITs have relatively higher gearing ratios, which means they have taken on more debt to finance their investments. As a result, they might be operating with less flexibility than their peers. The proposed rule changes could provide them with some much-needed breathing room, allowing them to manage their debt more effectively and potentially pursue new growth opportunities. This could be especially important for REITs that are looking to expand their portfolios or take advantage of new investment opportunities. Now, let's shift our focus to interest rates, a critical factor that can significantly impact the S-REIT sector. The reason for this sensitivity is that REITs often rely on debt to finance their properties, which means they are vulnerable to changes in interest rates. When interest rates rise, so do their borrowing costs, which can erode their distributable income. This, in turn, can affect the attractiveness of REITs to investors, who are often drawn to the sector's steady income stream. As interest rates continue to evolve, it's essential for investors to keep a close eye on how REITs are managing their debt and adjusting their strategies to mitigate the impact of rising borrowing costs. By doing so, investors can make more informed decisions about their investments in the S-REIT space. Here's the good news: interest rates are expected to decrease in the near future, which could bring about a welcome change for S-REITs. As interest rates drop, S-REITs may enjoy lower financing costs and higher distributable income, which is certainly a positive development for income investors. This could lead to increased attractiveness for investors seeking steady income streams. In terms of sectors to watch, analysts are favoring industrial, retail, and office REITs in the next 6–12 months. Industrial REITs, in particular, have demonstrated robust fundamentals, driven by strong demand for logistics and warehousing properties. This demand is likely to continue, making industrial REITs an attractive option. Retail REITs, on the other hand, might face some challenges with rental reversions, but overall, the sector is expected to remain steady, barring a significant spike in unemployment. Office REITs are also looking promising, with a potential uptick in demand for quality office space. Now, let's address the million-dollar question: is it time to buy S-REITs? Well, if you're a yield-seeking investor, S-REITs could offer an attractive spread compared to other low-risk investments as interest rates come down. The numbers are compelling. As of August 2024, the average dividend yield of S-REITs was 6.5%, compared to the 10-year Singapore government bond yield of just 2.4%. That's a significant difference, making S-REITs an attractive option for investors seeking a steady income stream. When considering investing in Singapore, it's essential to keep an eye on the broader economic outlook. While Singapore's economic growth has slowed in the first half of 2024, the services sector remains resilient, and the manufacturing sector is showing signs of stabilization, which could support rental growth and S-REIT performance. In addition to the economic backdrop, valuation is another crucial factor to consider. Currently, S-REITs are trading at relatively attractive valuations, with a forward dividend yield of 6.1% and a forward price-to-book ratio of 0.92 times, slightly lower than the 10-year average. Considering these factors, allocating 30–40% of your Singapore portfolio to S-REITs for the long haul may be a good strategy. S-REITs offer a mix of semi-annual dividends and potential capital appreciation, and with a market capitalization of around 110 billion Singapore dollars as of August 2024, they have become a significant player in the Singapore stock market. However, it's crucial to do your own due diligence and understand the role of the REIT sponsor, which can significantly influence the REIT's growth prospects and management expertise. Look for REITs with strong sponsors, as they have historically delivered better returns. Additionally, consider the geographical exposure of the REIT, as international diversification can provide a hedge against local market fluctuations. As of August 2024, over 92% of S-REITs and property trusts own properties outside of Singapore, which can help mitigate risks. In conclusion, S-REITs present a compelling investment case, especially in light of the proposed rule changes and the potential for lower interest rates. By understanding the nuances of this asset class and doing your own research, you can make informed decisions about whether S-REITs deserve a spot in your portfolio. Remember, investing is a marathon, not a sprint. Stay disciplined, stay diversified, and keep learning. And if you found this video helpful, be sure to smash that like button and subscribe to my channel for more investing insights. Keep learning and happy investing. Iggy the Investing Iguana, signing off.